Welcome back to Cashflow Lab. Today we're diving into something you hear constantly from politicians on both sides, really. This idea of reindustrialize America. It's like the one thing they seem to agree on.
It really is. It's become this national rallying cry over the last, decade or so.
Yeah, bring back manufacturing, make things here again,
Yeah.
reduce our reliance on other countries, especially China.
Exactly. And it's not just talk. Both the Trump and the Biden administrations have put some serious policy muscle behind it.
Huge muscle. We're talking about, sweeping tariffs on one side
Right. Really changing the trade landscape.
and then massive, massive subsidies on the other, like the Inflation Reduction Act, right?
Right.
Pouring hundreds of billions into green tech and EVs if companies build here.
Unprecedented amounts of money, really. The political will, it seems undeniable. They're definitely spending the cash.
Okay, but here's the core question for this deep dive, the thing we really need to unpack. Why isn't it working? Despite all this political agreement, all this money, all these policies, the actual macro data, the numbers, they seem to be telling a very different story.
Yeah, the data suggests things are not just stalling, but maybe even going backwards. Contraction, not expansion.
So why? That's our mission today. Why is America's reindustrialization push apparently failing?
Well, we need to dig into the source material here and look at the bigger picture. We'll cover the history first, how we got deindustrialized in the first place.
Right, the long view.
Then we'll look at the hard evidence right now, the data showing this contraction.
Okay.
And then critically, we need to unpack what look like 4 major economic roadblocks. These are fascinating because they show how the policies themselves, the tariffs, the subsidies, can actually backfire.
Create contradictions, you mean?
Exactly. Contradictory negative feedback loops, like tariffs that make parts more expensive for U.S. factories.
Or investment deals that sound great but end up strengthening the dollar, which hurts exports.
Precisely. And then there's this huge AI boom that's just like sucking up all the investment capital, leaving traditional industry behind.
Wow, okay. It sounds complicated. So to really get it, we need to start with the history. How did America lose its industrial might to begin with?
Yeah, let's step back first.
It does feel strange, doesn't it? America, the country that basically was industrial power for like half the 20th century, now trying to buy that back. How long has this decline actually been happening?
It's been a long, slow burn, really, not an overnight thing at all. The decline technically started way back, maybe after World War II, but you really see it pick up steam in the stats starting around the 1960s.
Okay, so decades.
Decades. And it accelerated pretty dramatically around the turn of the millennium, with China joining the WTO and globalization really kicking into high gear.
Give us those headline numbers again. Could they really frame the challenge, right? The scale of what they're trying to reverse.
They absolutely do. So think about manufacturing's share of the whole U.S. economy, the GDP. Back in the 1960s, it was roughly 25%. A quarter of everything.
Wow. Okay.
By the 1990s, that had already slipped to about 15%. Still significant, but a big drop.
And today?
Today, it's hovering around just 10% of GDP.
So from 25% down to 10%, that's huge.
It's a massive shift, a relative decline of, 60%? Just shows how much the economy has structurally changed.
And the jobs aspect, that's the really emotional part, isn't it? The part that fuels the politics.
Oh, absolutely. The job numbers are even starker in some ways. Back in the 60s, manufacturing jobs were about, again, 25% of all jobs in the U.S., 1 in 4 workers today. That number is down to just 8%.
8% from 25.
Yeah. And, these weren't just any jobs. Often they were high-wage jobs, union jobs, accessible to people maybe without a college degree. Losing that foundation fundamentally changes communities, the social fabric.
That loss, that's the anxiety you mentioned that politicians are tapping into.
Exactly. That's the core political motivation. But the mainstream economic thinking, at least before this recent push, was that this deindustrialization wasn't necessarily like a policy failure. It was seen as more of an inevitable outcome.
Driven by big global forces, right?
Wow.
2 main ones, usually.
That's the standard explanation, yeah. The first one is productivity gains. This gets overlooked sometimes, but it's huge.
Technology, basically. Automation.
Automation, robotics, better processes, smarter supply chains. It all means a modern factory can produce way more stuff with far fewer people than a factory from, say, the 1970s.
So even if we were making the same amount of goods, the number of jobs involved was always likely to fall.
Precisely. More output per worker. Fewer workers needed overall for the same volume. That's a big part of the story.
Okay, and the second big force, the one everyone talks about,
Globalization, no question. Once trade barriers started coming down and critically shipping costs plummeted, it just became vastly cheaper to make many things overseas.
Lower labor costs, especially in Asia. That's the point people always make. U.S. labor just costs too much to compete on certain goods.
Right. The cost differential was, and often still is, enormous. So, from a purely classical economic perspective, the argument was let other countries make the simpler stuff, the textiles, the basic electronics.
And the U.S. should focus on its comparative advantage.
Exactly. Focus on the high value stuff. Advanced tech, R&D, biotech, finance, specialized services, things where the U.S. theoretically had an edge. Reallocate resources rationally, as they'd say.
Rational, maybe, but like you said, politically difficult. It left a lot of people and places behind.
It absolutely did. And that leads directly to the anxieties driving today's reindustrialization push. It's partly nostalgia for those old jobs, but it's also a very real concern about dependence.
Dependence specifically on China.
Yeah.
It's not just about cheap plastic toys anymore, is it? It's about critical supply chains.
Oh, completely. Pharmaceuticals, key electronic components, rare earth minerals needed for batteries and magnets. The reliance is deep and wide-ranging.
And the scale of China's manufacturing dominance is just mind-boggling.
The sources put it starkly. China now accounts for something like 35% of all global manufacturing output.
35%. Just China.
Just China. That's more than the next 10 manufacturing countries combined.
Wow. Okay, that level of concentration is definitely a strategic vulnerability.
It absolutely is. And that feeds directly into the logic behind the tariff strategy, particularly favored by Trump and his team. They look at the huge U.S. trade deficit.
And see it as proof of weakness. If we made more stuff here, we wouldn't import as much, we might export more, and the deficit would shrink.
That's the core idea. Shrink the trade deficit by forcing production back onshore. So you end up with these two big distinct strategies aimed at the same goal.
Right. You've got the Biden approach, maybe call it the carrot, using subsidies, tax breaks, especially with the IRA, to lure companies, particularly in green tech, to build here.
Incentivize domestic production, yeah.
And then you have the Trump approach, the stick. Using tariffs to make imports painful, trying to block foreign goods and make domestic ones more appealing by comparison, and that dependence on China through trade pressure.
Two very different toolkits, but both laser-focused on bringing industry back.
And the kicker is, as we're about to see from the data, both seem to be hitting some serious roadblocks.
Yeah, the latest numbers suggest neither approach is quite delivering the promised industrial renaissance.
Okay, let's pivot from the intention, the policy goals, to the reality on the ground. We know billions are being spent, tariffs are in place. But what does the actual economic data say? You mentioned contraction.
Yeah, let's look at the hard numbers. A really key indicator is the Institute for Supply Management's PMI, the Purchasing Managers Index. It basically tracks activity in the manufacturing sector.
Right, above 50 means expansion, below 50 means contraction.
Exactly. And the latest reading for August showed U.S. manufacturing activity contracted. It came in below 50.
Okay, 1 month could be a blip, maybe?
You might think so, but this wasn't just a one-off. That August contraction marked the 7th consecutive month of decline. 7 months in a row below 50.
7 months. Wow, so that's not a blip, that's a trend.
That's definitely a trend. It tells you the sector is consistently shrinking, not booming. The PMI looks at things like new orders, production levels, employment. If they're all pointing down for that long, it signals real weakness. Factory managers are clearly pulling back.
Yeah, that sounds more like bracing for a slowdown than riding some wave of reindustrialization. What about the jobs numbers? Because that's often the headline metric politicians use.
The jobs numbers unfortunately confirm that pessimism. Despite all the talk about bringing jobs back home, manufacturing employment actually fell pretty consistently through the spring and summer.
Fell, even with all the subsidies.
Yeah. Between April and August alone, the sector lost roughly 42,000 jobs.
Losing 42,000 jobs in just a few months in the very sector you're trying to boost. That's not good.
It's sobering, isn't it? And it points to a lack of confidence among firms. This is backed up by layoff data, too.
Oh.
In July, the sources noted that 25% of manufacturing firms, 1 in 4, reported they were laying off workers.
A quarter of all firms.
Yeah. That's the highest share reporting layoffs since the absolute depths of the pandemic lockdowns, when, everything was artificially frozen.
So, if a quarter of companies are cutting staff now, that signals they don't see strong growth ahead. regardless of policy incentives.
It strongly suggests they're anticipating weaker demand or struggling with costs, yeah.
No.
Not exactly a sign of a sector roaring back to life.
Okay, but what about the counter-argument?
Yeah.
We do hear about an investment boom, right? Lots of news about billions flowing into new construction projects in the U.S. How does that fit in?
That's a really important point, and we have to look inside that headline number. Yes, there has been an increase in certain types of investment, particularly in structures, but when you dig down,
It's not what you might think.
it's almost entirely concentrated in one specific area, AI-related infrastructure.
So data centers, things like that.
Exactly. Massive, sprawling data centers needed to power large language models, cloud computing, all the AI stuff. That's where the overwhelming majority of this new investment is going.
So it's not necessarily traditional factories making tangible goods. It's the highly automated, capital-intensive infrastructure for the digital economy.
Precisely. It's a tech infrastructure boom, not a broad manufacturing revival in the traditional sense. And this creates a fascinating policy irony, especially regarding tariffs.
How so?
Well, think about what goes into building these cutting-edge data centers. You need incredibly sophisticated servers, specialized networking gear, advanced semiconductor chips.
A lot of which has to be imported, right?
Often, yes. The most advanced components frequently come from overseas. And here's the twist. Most of these critical AI-related imports are exempt from the very tariffs that were supposed to protect and encourage domestic production.
Wait, really? So the biggest investment boom happening right now is getting a pass on the tariffs?
Largely, yes. While a traditional manufacturer might be paying tariffs on imported steel or components, the AI data center build-out is often using imported tech that isn't subject to the same penalties.
That seems like a huge policy disconnect. The tariffs are supposed to help reindustrialize, but the main area of industrial investment isn't even being affected by them or is actively benefiting from exemptions.
It highlights how blunt instruments like tariffs can have unintended consequences in a complex, tech-driven economy. One policy's aim gets undercut by the reality of where capital is actually flowing.
Okay, let's talk about the other big number, the trade deficit. That was a key target, especially for the tariff strategy. We sometimes hear reports that the deficit has narrowed. Is that a sign the policy is working?
The trade deficit mirage. This one is particularly deceptive if you just look at the headlines.
A mirage. How so?
The reported narrowing is almost entirely due to really wild temporary swings in the import levels of just two specific categories, pharmaceuticals and gold.
Pharmaceuticals and gold. That sounds really specific. Why those two?
It seems to have been a classic case of companies trying to get ahead of anticipated policy changes. There was a massive rush to import huge quantities of high-value pharma products and gold bullion late last year.
Why? To beat new tariffs or regulations kicking in.
Exactly. They essentially pulled forward imports they would have made later, creating this enormous temporary spike in imports for those goods. Then, naturally, imports for those categories collapsed afterwards, making the overall deficit look smaller for a period.
So it wasn't a real structural change in trade patterns for most goods.
Not at all. It was a temporary distortion caused by stockpiling specific high-value items. If you strip out those anomalies, pharmaceuticals and gold, and look at the core trade balance for manufactured goods, things like cars, machinery, electronics,
What does that show?
it shows the trade deficit remains basically as high as it's ever been. There's been no sustained structural improvement in the underlying trade balance that the tariffs were designed to fix.
Wow. Okay, so contraction in activity, job losses, investment focused narrowly on AI, and a trade deficit that hasn't really budged once you remove the noise. The data picture is pretty grim for the reindustrialization narrative.
It really is. It suggests the political ambition is running smack into some very powerful economic realities. And that brings us squarely to why. Why are these powerful policy tools, the tariffs and subsidies, seemingly failing to deliver? The analysis points to four major interconnected economic roadblocks.
Okay, let's break them down. Roadblock number one.
Yeah.
Tariffs and input costs. The idea of a tariff seems so simple, right?
Yeah.
Make the foreign stuff expensive, people buy American. Why doesn't it work like that in reality?
It fails because modern manufacturing isn't simple. It's not like you just mine on ore here and make a whole car here anymore. It relies on incredibly complex global supply chains. You need, as the sources say, lots of inputs.
Right. Specialized components, specific chemicals, certain types of microchips, maybe even machinery to make the final product. Stuff that often isn't made domestically or isn't made competitively.
Exactly. So let's use an example. Say you slap a big tariff on imported steel to help U.S. steel mills. Okay, sounds good for them.
But
But what about the U.S. company that makes, say, construction equipment or cars? They need specific grades of steel as a key input. Now, because of the tariff, that essential input just got more expensive for them.
So the policy designed to help one domestic industry directly raises costs for another domestic industry.
Precisely. The tariffs on inputs break the flow. They make necessary components more expensive for American producers, which pushes up the total cost of making the final Made in America product.
Which then makes that American product less competitive, both overseas and maybe even at home.
Exactly. Less competitive internationally because its production costs are higher, and potentially less competitive domestically if foreign competitors can source inputs more cheaply elsewhere or find ways around the tariffs. It's a classic unintended consequence. The protectionist measure ends up hurting the price competitiveness of the very manufacturers you wanted to help.
That seems like a fundamental flaw in using broad tariffs in a world of complex supply chains. Okay, what's roadblock number 2? Foreign investment and currency movements. This sounds counterintuitive. We hear about deals bringing Japanese or European investment to build factories here. How is that a problem?
Yeah, this one requires dusting off macroeconomics 101, but it's crucial. While that foreign investment is good for jobs locally, on a macro level, attracting large inflows of foreign capital actually puts upward pressure on the U.S. dollar.
Okay, explain that mechanism. How does foreign investment make the dollar stronger?
So imagine that Japanese auto company wants to build a billion-dollar plant in, say, Kentucky. They have yen, but they need dollars to pay for the land, the construction crews, the materials here.
Because they have to sell yen and buy dollars in the foreign exchange market.
Exactly. That action buying dollars increases the demand for dollars relative to yen. Multiply that by many such investments from Japan, Europe, Korea, and the overall demand for dollars goes up. Basic supply and demand means the dollar's value rises against other currencies.
Okay, so foreign investment leads to a stronger dollar. Why is a stronger dollar bad for reindustrialization?
A stronger dollar is a double-edged sword. It's great for consumers buying imports. Foreign goods become cheaper.
But for exporters.
It's terrible for U.S. manufacturers trying to sell their products abroad. If the dollar gets 10% stronger against the euro, that American-made tractor or piece of medical equipment instantly becomes 10% more expensive for a European buyer, even if the dollar price hasn't changed.
So it kills their export competitiveness.
It significantly damages it, so you have this ironic loop. The policy success of attracting foreign investment, which is meant to boost domestic production simultaneously, makes it harder for domestic producers to sell their goods internationally because it strengthens the currency.
It's like stepping on the gas and the brake at the same time. The stronger dollar offsets the benefits of the investment or any subsidies.
To a large degree, yes. It helps explain why the trade deficit is so stubborn. Attracting capital inflows almost mathematically requires running a larger trade deficit because the stronger dollar makes imports cheaper and exports pricier. It's a fundamental macroeconomic relationship.
Wow, okay, that's a tough one. Roadblock number 3. The AI investment boom. You called it a capital sink. How is AI investment crowding out traditional manufacturing?
It comes down to competition for limited capital. Right now, there is an absolute tsunami of money pouring into AI infrastructure, those data centers, chip design, software development. We're talking tens, maybe hundreds of billions of dollars chasing these projects.
Because the perceived returns are huge, and maybe the risk seems lower.
Exactly. Investors see AI as the next huge growth wave. So if you're a more traditional manufacturer, maybe you want to upgrade an old factory, build a new plant for making, I don't know, home appliances or building materials you need to borrow money or attract investment too.
But you're competing against the AI giants for that same pool of capital.
Precisely. And the intense demand from the AI sector drives up the cost of capital interest rates, investment requirements for everyone else. It becomes significantly more expensive for that traditional manufacturer to finance their project. They get crowded out.
Because their project probably offers lower, slower returns compared to the hype around AI.
That's often the perception. Some economists are actually drawing parallels to the telecoms boom back in the late 1990s.
Oh, yeah. How so?
Back then, remember, there was this frenzy of investment in laying fiber optic cables, building out the early internet infrastructure. That boom sucked up enormous amounts of capital.
Right.
And many argue that it crowded out investment in other sectors, including manufacturing, making it harder for them to modernize, and possibly even accelerating the deindustrialization that was already happening. We might be seeing a similar dynamic today, but maybe even more intense with AI?
So the future tech boom is inadvertently starving the traditional industries they also want to revive. Okay, that's another major hurdle. Finally, roadblock number 4, the immigration policy contradiction. How does immigration policy clash with industrial policy?
This one is about skills. Plain and simple. If you want to build cutting-edge factories for, say, advanced batteries or semiconductors or specialized pharmaceuticals, you need workers with very specific, often highly technical skills.
Skills that maybe don't exist in large numbers domestically right now, especially for brand new industries.
Exactly. The fastest, most efficient way to get a new complex factory up and running is often to bring in experienced engineers, technicians, and managers from countries where that industry is already mature. They have the know-how, they can train the local workforce.
Okay, makes sense, bud.
But as you know, the political push for reindustrialization often comes packaged with calls for much tighter immigration controls, a more restrictive stance on visas, on foreign workers.
So the two policies are pulling in opposite directions.
Directly opposite. You can't realistically launch complex new industrial sectors that demand specialized expertise while simultaneously slamming the door on the foreign experts who possess that expertise. Yes, you can train domestic workers, but that takes significant time and money, and you still benefit hugely from having experienced foreign talent to lead the way initially.
And we saw a really stark example of this clash recently, didn't we?
Oh, the Hyundai plant's situation in Georgia was almost textbook. Perfect illustration. Hyundai's investing billions to build this big new electric vehicle component plant, exactly the kind of project everyone wants.
Right, a huge win for reindustrialization on paper.
Totally. And they needed several hundred specialized engineers and technicians from South Korea to come over temporarily to install complex machinery, set up production lines, and train the new American workforce. Essential people.
And what happened?
Immigration authorities, apparently applying existing visa rules very rigidly, things related to specific visa categories like L visas for internal company transfers, started detaining and even deporting some of these critical Korean workers.
Deporting the experts needed to open the factory.
Yeah. Because their paperwork didn't fit neatly into the existing, often restrictive boxes. So you had one arm of the government, immigration enforcement, actively undermining a flagship project championed by another arm of the government, industrial policy.
That sounds chaotic.
It caused a huge political scramble. The administration had to quickly backtrack, issue statements clarifying they value foreign talent, and essentially find ways to relax the visa enforcement specifically for those Hyundai workers.
A quick fix, but it highlights the underlying tension.
It perfectly highlights it. Industrial strategy and immigration strategy have to be aligned if you're serious about building advanced industries. You can't have one actively blocking the other.
So taking all this together, the historical decline, the current negative data of these 4 major roadblocks, it really paints a picture of just how hard this reindustrialization goal is.
It really does. We have to remember, we're not just trying to reverse a few bad years. We're trying to reverse a trend where manufacturing's share of jobs has been falling pretty much continuously since its peak way back in the 1920s.
The 1920s, wow. So this has been going on for a century.
A century-long structural shift in the economy. Trying to turn that ship around quickly was always, frankly, a bit of a long shot, as the source material might put it.
And the really sobering takeaway from the current data and these roadblocks isn't just that it's not happening.
Right. It's that some of the policies being used, especially the tariffs, might actually be making things worse for domestic manufacturers.
By raising their input costs.
Exactly. And by contributing, along with foreign investment flows, to a stronger dollar, which crushes their export competitiveness. The medicine might be harming the patient in some respects.
And looking globally, which was a big part of the motivation competing with China, reducing dependence. Where does this leave the U.S. in that industrial dominance battle?
Well, based on the current trajectory and these structural headwinds, high U.S. labor costs, the continued need for global inputs, the capital being diverted to AI, the workforce challenges, it seems pretty clear that China maintains a significant advantage.
They still hold the upper hand for now.
For the foreseeable future, it appears so. The U.S. seems caught, doesn't it? Caught between the political desire for purely domestic production and the economic reality that modern manufacturing is deeply globalized and incredibly cost-sensitive. #outro. So let's try to crystallize the main takeaways for you listening to this deep dive. First, those reindustrialization efforts, they're running into some serious policy contradictions.
Right. Tariffs are meant to help, but they raise costs for domestic firms using imported parts. Getting foreign companies to invest sounds great, but it strengthens the dollar, making it harder for all U.S. firms to export.
Exactly. Second takeaway. The hard data just isn't showing success right now. Key indicators like the PMI show manufacturing activity is actually contracting month after month.
And we're seeing job losses, not gains, in the sector.
Mm.
Plus, that shrinking trade deficit we heard about, mostly a statistical illusion caused by temporary surges in pharma and gold imports.
Mm-hmm. And the third key point, that investment boom you hear about. It's real, but it's overwhelmingly an AI story, not a traditional factory story.
Billions going into data centers, which is great for tech, but it's sucking capital away,
Mhm.
making it more expensive for old-school manufacturing to borrow and modernize.
Precisely. Which leads us to a final, maybe provocative thought for you to mull over, connecting these threads.
Okay, sure.
If the political goal driving all this is bringing back the old manufacturing jobs, the kind of assembly line work common in the mid-20th century,
Yeah.
but the economic reality is that the only major industrial investment happening is in highly automated AI infrastructure, which needs fewer workers overall, and those workers often need specialized skills that might have to be imported.
Uh-huh.
Does that mean the political ambition is fundamentally out of sync with the economic reality of where manufacturing is actually headed in the 21st century?
Are they fighting yesterday's war, essentially? Trying to recreate the 1960s economy when the future demands something totally different. More automation, different skills, deeper global integration, not less.
That seems to be the core tension, something to definitely think about next time you hear those promises about factories returning.
Indeed. Thanks for digging deep with us on Cashflow Lab. We'll catch you on the next one.